Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Frac Spread Count show, we're going to talk about, obviously, the Frac Spread Count, what's happening within the U.S. Then, so Bloomberg put together a really good article looking at Russia and some of the things that they've done to help insulate themselves from potential sanctions. And these are things that, for those that get our insights, we've been talking about this over the last few years. And it's just something that I want to drive home now that the Bank of Russia has put out some decent data points that we can really use. And then we had a really good jobs number and a good revision on the jobs data that we also want to talk about, because we think it's important when we're looking at inflation and that dual mandate that the Fed has, which is obviously full employment and inflation. So as you can see, I shook off my my normal Under Armour. I'm repping my favorite F1 team, McLaren, and I'm a big Daniel Ricciardo fan for those that follow Formula One. But just one of those little things, because my kids went up to me today and said, "No, Daddy, favorite symbol today?" I'm like, "Nope, not the favorite symbol today." So no Under Armour. With that being said, the Frac Spread Count for today is up by 3. Now, it's important to appreciate what happened today. Now, when we look at what is the Frac Spread Count, we're always taking the highest point of the week. So the highest point was at the beginning of the week, and then we did have some equipment not go down, but just slow, just because of the winter storm that came through. We had icy roads. We had, it really wasn't like Uri. So let's just compare it to what happened with Uri last year. Uri was a massive freeze-off. You're talking about, not only just roads that were impassable, but freeze-offs at the wellhead. You had to turn off and shut down equipment. You had freezing water. You had a lot of problems when you're looking at frac spread counts. So you just sent people home. This was an all-out stop. For those that look and get our data, you can see that massive drop. And like, I actually had people call us saying, "We think there's an error with your data." It's like, nope, that was Uri, and that was the collapse. So here we had some disruption, but I would say it was probably maybe about 3 to 5% in the Mid-Con and about 3% in the Permian. And it was mostly due to road issues in terms of iced over roads, the inability to get water, chemicals, proppant, depending on where we were. So realistically, this is something that we're still comfortable with, what the activity peaked at this week, and it keeps things moving along. We do expect to see a bigger increase as we come on the other side. We had some refiners that ramped down some activity ahead of the winter storm. They're ramping back up. Again, it's just trying to be prudent in terms of what was happening. We've seen ERCOT prices come back down. So that's really just a long way of saying that, we're still on pace. This is something that we had a little bit of a disruption, but most of that is now back online and will be back online at the latest on Sunday. So that's why we are comfortable with that 264, so that increase of 3, and especially because some of the increase happened in the Williston Basin. So we are starting to get some Bakken, and if you think about where the Bakken has to be, it has to be between about 20 to 22 spreads to really get things growing again. And right now we're just kind of holding things flat. So we do think that there's going to be a continuation, especially as we come into March, April, when weather permitting, things get a little bit more active in that region. So again, still steady pace, still on track to have that additional 10 spreads because remember, we peaked at 274, something that we still think is very doable within the next few weeks. Looking at rig count, again, they're going to be subject to the same issues that we saw throughout the U.S., I should say throughout some key oil and gas regions. Even with that, there was a net increase when you look at it of 3. But again, we always like to break down where. So you had 2 oil, 1 gas. But when you look at what the situation was, horizontal had another increase of 2. Vertical had an increase of 3. So again, the horizontal continues to see activity picking up. There continues to be that focus on, well, where is the DUC capacity and where are things going on the next few quarters. And when we look at what happened and what was said by Exxon and Chevron, the Permian is getting capital. There's going to be some fresh capital infusion. And ConocoPhillips talked about how they're taking their guidance up by 900,000 barrels. Now, it's important to clarify what product, because when you look at what our expectations are, we were saying that we were going to end the last year at the high point. Our top end of that range was 11.7 million barrels. We closed out the year by about 11.75. So we're expecting an exit rate this year of 12.2 to 12.3. So you might look at that and say, well, that doesn't jive with what was being said in earnings. And I think it's important because we're speaking oil at that point, because when we look at liquids as well, and we factor that in, we do see about a 900,000 barrel a day increase, but with about 500,000 barrels being oil, and then another 400 to 500,000 being liquids. So again, the liquid side, as we've been saying since 2020, 2019, for those that watched me on Bloomberg, we're very much in the space that the liquids is going to be a big driver as we go through the remainder of this decade, especially when you look at what is happening not only in the Middle East, but also in other areas. Now, it's important to look at what has happened with spreads, because when you look at the spread between Dubai and WTI, it's now back over $5. It's just blowing out everywhere. And it's important to look at it in terms of how does it look against the Middle East going into Asia, and how does it look in the US going to Europe. So when you look at Brent versus WTI, you can see that it's widened out a bit, but it was closer. So it's about $1 spread, which is typically, is a very, very tight spread for where it normally goes. But you have to consider what is happening in the market right now. Now, we covered it a bit in the EIA segment 3, but we are seeing European refiners not buying Urals or just avoiding Urals in general, because nobody wants to be stuck with the barrel if sanctions are put in place. So because of that, you're seeing Urals trading at 6-month lows in terms of just differentials, in terms of pricing, but you still need crude. So if you need crude, where are you going to go to get it? And that's where we're seeing more activity coming from the US. Now, this spread is just essentially turning off all flows into Asia, still maintaining flows into Europe, and that's where we're seeing some of this back and forth that we discussed on the EIA show, and keeps us confident that we'll see about 2.7 to 2.8 million barrels a day of exports, even though we had a low number, just because Europe is going to be a buyer, and with Europe also avoiding some of these Euro barrels, that should start to put a bit of a bid into Nigeria. So far, Nigeria has been very slow to clear. Angola, Congo was going at a good pace, and then it slowed. That's more seasonal just because of Lunar New Year. So we do expect to see some of that coming up. Now, when we look at what have we seen so far, when you look at Libya had to cut production because their storage is full. And the reason why that's the case, and they had only had to cut 100,000 barrels of production, but they have weather issues right now, which has shut down 6 ports. That will adjust, and then things will get back to normal. So when we look at Eni, for an example, offered 100,000 tons of Urals for $2.80 less dated Brent. It's last traded between 310 to 315, the less dated Brent. So again, you're seeing it stay between this 315 to about 275, and it's just bouncing in between, just in terms of where things are sitting. Due to the concerns around sanctions. But now we have to talk about sanctions, because one of the things that we've been talking about since they really started the pivot, which was 2014, was reducing their exposure to the US dollar. And the way they've done that is increase gold positions and increase their exposure to non-US dollar currencies. So they've been increasing foreign exchange, including dollars, but they've been weighting it a bit more into euros, into yen, and diversifying more away from the US dollar. They've also been trying to take down gross foreign debt to minimize some of these impacts that they could have and the difficulties that they would have with the borrowing side. Again, they've also been trying to stay within their means a bit more because they've had a struggle on an economic level. But this just gives you an idea that international reserves, as we saw starting in 2014, into 2015, that was when they started to make this move. They dumped some dollars. They started to pick up gold and other foreign currencies. And that has been a mantra that they've continued the whole time, peaking at this point now with over 650 billion. And this is just looking about the dollar pivot. Because when you look at what happened in 2018, you can see that big drop. And then when that drop happened, they took that money and then put it into both euro and yen to get away from some of the dollars. And they've actually been trading crude into Europe, and transacting in euros, not in dollars. Now, they've always tried to get China to transact in rubles. So far, there's been a bit of a pushback, but that is something that could happen, especially if the U.S. puts sanctions on Russia. Now, another key piece is there's, again, shifting away from the dollar. So this is just showing you how they've already been doing it. Obviously, it's very difficult. Over 80% of global trade is dollar-based. But again, this is something that they're trying to do to try to minimize impacts. Now, they just signed some new deals with China as recently as yesterday and today. And it's just increasing some flow, confirming things going now, extending the contracts for another 10 years, going from 2022 to 2033. So again, getting further into the and increasing their relationship. So I thought this was a really good chart put together by Bloomberg, where it just shows you where the ruble has been and how it's really underperformed Brent. And that's and again, Brent is moving up with a lot of geopolitical risk, but the ruble's not really keeping pace because people are already factoring in some of these additional hiccups if there is some sort of invasion, which then results in some in a significant amount of sanctions. Now, if that happened, China has a choice. They could either say, "Look, I'm sorry," and they can maximize pressure on Russia by saying we're still going to transact in dollars, or just based on how much really product China needs, they're going to say, look, we'll transact in ruble. We'll buy it at discount because you're going to have to give up something. We'll buy it at some sort of a discount and we'll transact in rubles. And that would be a huge win for Russia. And it would be another way to kind of put a slap, China can hit US where it hurts, which is, again, that dollar dominance, which is something that's very important when you think about dollar dominance and where things are shifting on the yield front. So before we get into that, we want to look at global food prices, which are back on the rise. You can see that the level is about to take out the 2011 highs, which we think it does. But when you look at year over year, the rate of change is slowing, but the actual gross number, the actual dollar value, is still trending higher. It's just not trending up at 5-7% clips. Instead, it's trending up at 50 basis points to 1%. So we do think that we will take out that high within the next month. And again, just increasing the pressure on the emerging market front as they keep focusing on the dollar, as crude is now at $92. So you're seeing a lot of this pain and a lot of this pressure that is hitting some of these specific markets. Now, for the first time in a long time, the 30-year real rate is over 0%, which just means that it's actually covering the nominal amount. The 10-year is still negative. It's something that this is one of the calls that we've had since February of last year, that we were going to see the 10-year take out 2% and that it will go. So now, based on that, we do think it goes positive and it's just going to be dragged up. And when you look at what this looks like, and not to get too complicated on rates, but we're seeing that bear steepener where you're seeing pressure on the front months as the 10-year, essentially from the 7-year out, continues to shift higher, again, putting pressure on where those inflation expectations are. Now, the reason why this is important is because when you look at what the Fed has decided, in the near term rather, is that they're going to try to protect the dollar. Now, the dollar, to be very clear, we do not expect the dollar to explode. It's just going to be, it's very well positioned. It'll likely drift its way up to 97, but we've seen a bifurcation in terms of where commodity prices are and where the dollar is. And it's something that we think is going to weigh on some of these prices. I know there's a lot of expectations that China comes back, they come back aggressively, and that's going to absorb some of the spare capacity. But again, this is something that when you look at the dollar pressure, that's something that I think is going to weigh, especially when you weigh it against inflation and weigh it against how some of these commodities are priced. And some of the confidence that gives us, when you look at the Fed and what they're doing, obviously inflation is moving higher. We've discussed that already. Crude being at 92 is not going to help. But when you look at payroll, when you look at jobs, the expectation was for an increase of 125,000. There was an increase of 467,000. And then when you look at the revision, which was 199,000, which what they said was in January, taken up to 510,000. So you're getting a net 2-month payroll net revision of 709,000 jobs. So as we said over the last several weeks, if we're not at full employment, we're damn well close. And this puts us right at full employment, which again is going to keep the Fed on pace to cut to end QE in March and to continue to raise rates. Another key factor, so the unemployment rate ticked higher, but that is normal when the participation rate increases because more people are actively looking. So that's not a negative, that's actually a net positive. And you do have a very elevated quit rate, so people are still actively leaving. Then when you look at earnings, earnings were expected to be at 0.5%. They came in at 0.7%. Year over year, they were expected to be at 5.2%. Instead, they came in at 5.7%, which is a very big positive. And this is what we've been saying is we expect wage increases. We 100% expect wages to go up. The question will be, does it keep pace and then eventually outpace where inflation is right now? So when we look at small businesses, so a record 50% of small businesses raised compensation in January, yet then 27% plan to raise compensation in the next 3 months. So which is the orange one, which is a tick down. So you're seeing some of these wages pick up, but they do see wages kind of ebbing out, which fits with what our view is, where you typically have wage increases in March, April, May, and then you start to dial that back because you typically have the most hiring that's done in that March, April, May period. People who quit their jobs in December, January, February after they get their bonuses, and then the job market really starts to pick back up in that early spring through spring into early summer is that key point. But this is just showing some of that front-loaded impacts that we're talking about on the inflation front. Now, when we look at jobs, you can see that jobs have picked up. There's still some room to grow in terms of where they're going to try to close this gap. I just think we're getting closer and closer to that full employment. Some of these positions had too many employees, and I think they used COVID as a way to kind of cull some of that. And now I don't think some of these I think are going to remain fairly sticky in terms of not getting back to that pre-pandemic level for those reasons, where these are jobs that will just never come back, which we outlined very, very aggressively in April of 2020, and then again at the end of 2020, and then throughout 2021. Now, when you look at the average weekly hours for all employees, it ticked down a bit. But again, these are things that people are getting a bit more productive, because if you remember, there was a productivity shortfall, which has started to come back. This is something that we do expect hours to tick higher again and really just kind of stay within this realm as things start to normalize a bit with a bit more inventory and some of these assembly lines coming back. Now, some of the best news continues to be that long-term unemployment fell again. Only 26% of those unemployed have been without a job for over 27 weeks. So again, that's just bringing people back into the fold, back into the jobs front, which is going to increase that unemployment rate in the near term, but net of a positive move. And then the prime labor force participation rate also stronger, up to 82%, which is the highest since the pandemic began. And again, you're still trying to get back to this 82.5 level, which it'll happen. It'll just take a bit of time. Now, when we look at wages, this is just giving you an idea of where wages are now. Wages back on the rise, and that's the fastest gain since the summer of 2020. And this is something that we think is going to remain strong. It'll level off a bit, but again, still remaining elevated and in a positive front. Now, it's always important to weigh that against what the financial situation is at the local level. or the consumer level rather, because again, even as wages go up, is it enough to adjust their financial situation to protect against rising costs? So per their most recent Gallup poll, 41% of Americans say they're better off financially than a year ago, up from 25% in January, but below the record high of 59% in Jan of 2020. Identically, 41% say they are worse off than a year ago, up from 36% in 2021. And just based on what we're seeing, we think that we're going to see a bit of a trend in terms of people who are starting to feel the pinch from the inflation side. But especially as you have now gasoline prices back to or near all-time highs, depending on the location we're talking about, diesel going higher. And again, these are some of the key pieces that are going to impact the individual retail investor, buyer directly as they continue to see their costs rising and will wages keep pace. So that's all we have for you today. Hopefully you have a great weekend. For those that weathered the storm, hopefully no one's pipes froze. Everyone is safe. So we thank you again for watching. If you have any questions, you can find me in the comment section or again on Twitter. And we hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.